Hello and welcome to another chapter on US taxation. So today we are here to present on Schedule C, which is the main component to report the income, which is a business income. So up to this point in our journey through Form 1040 and its supporting schedule, we have focused primarily on the income reporting, adjustments, additional taxes, and then credit taxes and the optimization. But now we are stepping into one of the most practical, dynamic, and highly scrutinized area of taxation, which is the business income. So Schedule C, which is the profit and loss from the business, which contain the detail for all the income which is reported by a business, and then it also helps to derive the gross profit. Then we have to deduct the expenses to get the final net profit, which is the income which finally moves into Schedule C, and then through Schedule C it is linked to Form 1040. We'll have the deep understanding and the line by line detailing for each of the component of the income and the expense. So with this, let's move to the agenda for the Schedule C, which is the business income. Okay, so the key agenda that we're going to cover is introduction to the Schedule C. We'll talk about who must file the Schedule C, understand the structure of Schedule C, and then we'll do a deep dive for the business income. We'll understand the cost of goods sold, and then we also do the deep dive of the business expenses. We'll understand the deductions which is being available from the home office, and then we'll understand the concept of depreciation in section 179. We'll understand how the net profit is calculated, and then how Schedule C is integrated with the other forms. We'll also understand the self-employment tax deep dive, and then a complete practical case study to understand the end-to-end flow. And then we'll end up this session with the quick synopsis type, which demonstrate all the key takeaways from this chapter. So with this, we'll move to the first slide, which is the introduction to Schedule C. Okay, so we'll talk about the first slide, which is the introduction to Schedule C. Now, Schedule C is used to report the business income. It's used to report the business expense, net profit or loss from the self-employment, and then it is one of the most important schedule for the freelancers, consultants, small business, and gig workers. So the purpose of Schedule C is to calculate the net profit and the loss for the business, wherein formula is very simple, wherein business income minus the business expense gives us the net profit and loss. The most important question is like who must file these file Schedule C. So this is applicable to sole proprietors, independent contractors, freelancers, self-employment individual, and the gig economy workers. But they're not applicable to WT income holders, corporate filing separate business returns because they have the separate business return for this separate set of income. The key component of Schedule C is the income section, which captures the gross receipts, sales, and the other business income. It also captures the cost of goods sold, which is applicable for product-based businesses, which includes the inventory, purchase, and the direct expenses. And then it has the expense section, which captures the ordinary and the necessary business expense. So example, advertising, rent, utilities, and the other travel expenses. So important concept here is that expenses should be necessary and the ordinary. I mean, if they are not necessary and they are not within the ordinary course of the business, then these expenses are not deducted from the income to derive the net profit. Then we derive the net profit by subtracting the expenses from the business income to derive the final Schedule 1, which goes to the Form 1040, and then it flows into the Schedule SE. So Schedule C flows into the Schedule 1, and then from Schedule 1 it goes to Form 1040. The net profit also takes into the Schedule SE, which is the self-employment tax. So Schedule C determines the taxable business income, self-employment tax liability, and the deduction eligibility. Common use cases is freelancing, consulting, content creators, and the Lyft drivers. And then Schedule C is considered as a highly risk area or scrutinized area by the IRS because it also includes all the deductions. So risk is that excessive reductions can be claimed, personal expenses can be claimed, and low incomes and the high expenses can be done. So Schedule C is where the business activity gets translated into taxable income, and it is the most practical and the widely used schedule in the real world tax file. So we'll move to the next slide. So then who should file the Schedule C? So we'll understand this. So Schedule C is to be filed by the individuals who operate a business or perform the services as a self-employed person, used to report the business income, business expenses, and net profit and loss. Primary taxpayer requires to file the Schedule C. So sole proprietors and the freelancers, independent contractor, gig workers, single member LLC, all these people are required to file the Schedule C. Key filing condition is that Schedule C is generally required when individual has a business income, self-employment income, and profit motive activity. Who does not require to file the Schedule C? So pure salaried employee do not require to file the Schedule C. C corporation, S corporation, because they have the separate returns, and hobby activity without a profit motive. So we'll quickly touch base that what is the hobby versus the business rule. So IRS evaluates the intent to earn the profit. So if the intent is not to earn the profit but to simply execute the hobbies, then there is a limited deduction treatment. Failure to file the Schedule C may result in the underreporting income, and IRS notice and penalties may invoke. Schedule C applies to the wide range of the taxpayer and not only to a traditional business owner. In today's gig economy, freelancers, consultants, creators, and online sellers are fall under the category wherein they have to file the form Schedule C. So we'll move to the next slide to understand the structure of the Schedule C. Okay, now we'll understand the structure of Schedule C basically. So Schedule C is basically the profit and loss from the business, wherein income reported from the brackets like for self-employed report business income, deduct ordinary expenses, calculate profit and loss, and then finally impact tax on the self-employment tax. So all this income and the related information flows from the Schedule C to Schedule 1, and from Schedule 1 it moves into Form 1040. So end objective is that earn business income, track income and expense, calculate net profit, report on Schedule C, and then follow to Schedule SE and Form 1040. So we'll move to the next slide to understand the line by line understanding of the Schedule C. Okay, so we'll talk about the business income section and line by line deep dive. So the business income section of Schedule C capture the gross business revenue, return and allowances, cost of goods sold, and the other business. So objective is to calculate the gross profit and the gross income. So if you look at the line by line breakdown, so line one is the gross receipts or the sale. So total revenue earned from the product and the sold and the services are provided here, which includes the cash, check, online payments, etc. And then 1099 income as well. Any refunds issued to the customer or discount or sales returns are being reduced from this line one to derive at the gross sales. And then so to derive the net sales rather, because this deduction reduces the gross. Then we have the net receipt, wherein we have to do the line 1 minus line 2, which represent the net business sales during the particular period after all the adjustments. Then we have line 4, which talks about the direct cost of the producing the goods, which is normally called as cost of goods sold, which includes inventory, raw material, direct labor, and the manufacturing cost. And the detailed calculation come to the part 3 of the schedule C. Uh, so once we have the total sales and then we have deducted the related returns from it, we have the net sales, and we also have derived the cost of goods sold by accumulating all the costs that has been incurred to manufacture the product. Then we are in a position to derive the gross profit. So gross profit is the net sales minus cost of goods sold, and this is represent before operating expenses. Then we have to add other income here. So additional business income which are not included in this is like some of the rebates are there, interest rate to the business and miscellaneous operation income. So we'll add that additional income to derive at the final gross income. So once we have the gross income, then we have the expenses that we are going to deduct from the final gross income to derive at the net profit. So sales adjustments, net sales, COGS minus when we minus the COGS, we have the gross profit, and then we have other income, and then we have the gross income. And when we deduct all the expenses, we'll have the final net profit. For the expenses, we'll go to the next slide to understand the line by line for the expenses. This section is largely speaks about the total gross income, excluding the operating expenses. All operating expenses will be covered in the next slide. Okay, so before actually moving to the expenses, we'll first try to define the cost of goods sold also. So cost of goods sold is basically the direct cost incurred to produce or purchase the goods sold by the business. So applicable mainly for the product-based business, manufacturing, retailers, etc. The purpose of the cost of goods sold is to help you determine the gross profit, because formula is net sales minus cost of goods sold equal to gross profit. So when COGS is reported on the Schedule C line 4, detailed calculation is performed in the part 3 of the Schedule C. So component of COGS are beginning inventory, we have the purchases, we have the cost of labor, we have the material and supplies, we have the ending inventory, and the cost formula is beginning inventory plus purchases plus direct costs minus ending inventory, which will give us the cost of goods sold. So we can use the formula FIFO, which is very relevant and preferred. LIFO whenever permitted, and then specific identification formula. And this is very important because these are the listed formula which is being defined by the IRS. So COGS is far more than just an accounting number. It directly impacts the taxable profit. So proper inventory tracking, the accurate cost allocation are essential to do the compliances for the effective tax reporting. Now we'll move to the next slide and understand the expenses line by line. So we'll move to the next slide. We are having the business expense. We'll go to understand line by line. So expenses section of Schedule C capture the ordinary and the necessary expenses. This is very important keyword because only the ordinary expenses are allowed. Any extraordinary expenses which is beyond the permissible limit are not allowed. However, there is no defined limit, but it has to be justified. Then we have the expenses which are necessary to run the business and any kind of the expenses which are for a personal nature and which do not have direct correlation with the business activity. Those are largely disallowed. Business expenses must be ordinary, which is common in the industry and the necessary and helpful for the business to operate the business. So we have advertising, car and truck expenses, commission and fees, contract labor, depreciation in section 179, employee benefit program expenses, insurance, interest, legal and professional expenses, office expenses, pension and professional plans, rent and lease, repair and maintenance supplies, taxes and licenses, travel and means, utility, wages, other expenses. So this is the comprehensive list of the expenses that will be allowed as a deduction from the gross income to arrive at the final net profit. And the most important criteria for claiming these expenses is that those needs to be incurred in the ordinary course of the business, and these expenses has to be necessary to make sure that the business can run and operate as per the required conditions. And total expense calculation is the sum of the direct expenses which flows into the net profit and loss computation. So business expense directly impact taxable profit. While deductions provide the tax saving, they must be carefully classified and supported with the documentation and to withstand the IRS. So we'll move to the next slide. Okay. So home office deductions, what are these? So typically when we are using the home as a place of business, then what kind of deductions are typically allowed? We'll come to provide. So basically home office deductions. So a home office deduction allows a self-employed taxpayer to deduct the expenses related to the business used or use of their home applicable mainly to the sole proprietors, freelancer and the independent contractors. So basic eligibility criteria is that to qualify the home office must be used exclusively used for the business, regularly used, consistently used, and the principal place of the business and the main location of the business activity should be the place where person is residing. There are two methods to it. So first formula is that very simple, wherein we use the $5 per square feet charges, and then the maximum square feet area is 300 square feet. So maximum reduction is $1,500. So basically, the advantage is that it's easy calculation, less documentation, lower tax complexity. Actual expenses method is like wherein we are taking the actual expenses. So deduction is based on the actual home expenses allocated to the business use. So expenses allowed on the actual method is basically expenses actually for the office area. Example of the office painting, office repairs, and the fully deductible. Indirect expenses like shared home expense allocation proportionally. For example, rent, mortgage interest, property taxes, insurance, internet, business use percentage calculation formula. So basically, total office area divided by the total home area, that will give us the allocation of the expenses. We have the percentage, and then we have to apply that percentage to the annual expenses to derive at the expenses that can be claimed as a home office deduction. So home office deduction flows into the Schedule C expense section. It reduces the net profit and the self-employment tax exposure. And home office deductions are valuable but highly sensitive for audit perspective. And so because these are the expenses which are impacting to reduction in the business profit, and hence it also subject to the scrutiny. So we'll move to the next slide. Okay, now we'll talk about another important section, which is the depreciation and section 179. So when we talk about depreciation 179, so basically these are the depreciation on the equipment that we're using, for example, equipment, computers, furniture, vehicles, and machinery. Basically, it's a charge on the usage of the asset, and common depreciable assets are office equipment, furniture, vehicles, machinery, and the building. Uh, Assets cost is spread across the IRS defined recovery period. For computer, it is 5 years. For office furniture, it is 7 years. There's also one section, section 179, which allows to deduct the entire expenses which is being incurred to purchase that asset in the single year itself. So immediate tax reduction reduces the current year taxable income and improves the cash flow. Assets eligible under section 179 are the computers, office furniture, equipment, machinery, and the certain business software. But it has a limitation that deduction subject to the annual IRS limits and the business income limitation and cannot be generally create the large business losses. So then we have some accelerated depreciation which can be allowed as per the law, wherein instead of taking the depreciation as per the rules, we can have the accelerated depreciation that can allow the higher depreciation in the year of the purchase itself. And then depreciation is section 179 is integrated with the schedule C, and then it reduces the net profit and the self-employment tax exposure. So depreciation spread across the overtime, while section 179 accelerates the deduction in the current year. Choosing the right method is an important strategic decision for the business plan. So choice is there to opt for 179, or choice is there to go with the phased depreciation methodology. So we'll move to the next slide. Okay. Now we'll talk about the final net profit and loss calculation. So we have understood the concept of gross profit, we have understood the concept of COGS depreciation, and now we'll understand then how step-by-step calculation is done to arrive at the final net profit. So core formula is gross income minus distributing expense is the net profit. So first of all, we have to calculate the gross receipt. We have to reduce, return the losses to get the final net sales. Then we have to subtract the cost of goods sold to arrive at the gross profit. We'll add the business to get the final gross income, and then we'll reduce the business expenses to get the final net profit. And then it is integrated with the other forms. Net profit to Schedule 1 and Form 1040 and Schedule E are all integrated. And in case of the loss, then it has to be towards the net loss. So this calculation is the heart of the Schedule C, and every income and expense from ultimately flow into the net profit figure, which directly impact both the income as well as the self-employment tax. So we'll move to the next slide. Okay, now we'll understand the integration of Schedule C with the other forms. So integration is Schedule 1. So purpose of net profit from Schedule C flow into the Schedule 1, which is the additional. So entire information from Schedule C flows into Schedule 1, and from Schedule 1 it flows into Form 1040. So Schedule C net profit flows into Schedule 1, and then it flows into Form 1040. So impact increase in the total income and adjusted cost. How it is integrated with Schedule SC? So Schedule C net profit moves into Schedule SC, where in Schedule SC it moves to Schedule 2, which is the additional tax, which is the employment tax, self-employment tax, and then from Schedule 2 it moves to the Form 1040. Integration with Form 1040, final reporting of business income, additional taxes, and the AGA impact. And then it is integrated with the Form 4562, wherein information from Form 4562 flows into Schedule C, which is expense section, which is depreciation one. And then it also has the information coming from Form 8829, which is largely the home office deduction, and the information from 8829 flows into Schedule C expenses. So typically, Schedule C entire information flows into Form 1, and then it moves into Form 1040. Likewise, information from SC form moves into Schedule 2, which is the additional taxes, and then final information resides within Form 1040. So we'll move to the next slide. Okay, now we'll understand and have a quick update on the self-employment tax. So self-employment tax, if we look at it, is basically the tax which is being paid by the self-employment individuals. The self-employment tax is paid by the self-employment individuals to fund the Social Security and the Medicare, which is equal to the payroll taxes within the with help from the employees. So why does it exist? Because self-employment individual effectively is equal to the employer and the employer. Component of self-employment tax is Social Security tax 12.4% and Medicare tax, which is 2.9%. Total SC tax is 15.3%. It flow from the Schedule C net profit to Schedule SC, from Schedule SC to Schedule 2, and from Schedule 2 to 1040. So first we have to determine the net profit from Schedule C. Then we have to apply the IRS adjustment, which is 92.35% of the net earning are subject to the SC tax. Then we apply the SC tax and then Social Security Medicare tax. So additional Medicare tax is there for the high income tax payer, and then additional Medicare tax of 0.9% is also charged, which is over and above the tax which is being charged on the self-employed. So self-employment tax is often the biggest surprise to the new business owners, since self-employment individual pay both the employer and the employee portion and the payroll taxes. Understanding the SC tax is critical for the proper tax planning and the compliances. Okay, so we'll have a quick look at the practical case study for this entire scenario. So we have a freelance marketing consultant as the name of the individual, and then it's a sole proprietorship with the income detail as follows: income, consulting income, online course income, and the affiliate income. Totals comes to 1,40,000. Assume that there is a client refund of 5,000, then we have the net sales as 1,35,000. So cost of goods sold, assuming that the cost of production is 10,000, then we have the total cost of goods sold as 10,000, and the gross profit is 1,25,000. Then we have all the list of the expenses here. Before that, let's assume that there is a additional income of 2,000. So gross income is 125 plus 2, which is 127. Sum of all the business expenses is 50,000. So net profit is 127 minus 50, which is the 77,000. Then we have to apply the self-employment tax. We'll apply 92.35% of 77,000, which is 71,110. We'll apply the SC tax, which is 15.3% of 71,110, which is 10,880, and the deductible portion is 50%, which is 5,440. So all this information will flow into the various schedule, and from various schedule it forms into Form 1040. So schedule 1, which is the income, and the schedule SC, which is the self-employment tax. Information flows into Form 1040. So business income to schedule C, net profit schedule 1 and 1040, schedule SC, and then the schedule. So this is how the entire income from the various schedule flows and integrated to each other. But final place where all these schedule have the precedence is the Form 1040. So we'll move to the final slide, which is the key takeaways. Okay, so the key takeaways from Schedule C is that Schedule C is the foundation of the business taxation. It is used to report the business income, business expenses, and the net profit and loss. And then it is for very much important for freelancers, consultants, sole proprietors, and gig workers. Business profit drives the multiple tax calculation like income tax, self-employment tax, EG, and estimate application. Accurate income reporting is critical because the information which reported here is the cash receipts, 1099 income, and the other platform income. It has the direct impact by reducing the COGS from the gross receipts. Then it can also allows the powerful expenses, powerful tool to powerful schedule for all the expenses that are required to run the business. Home office and depreciation are required to be deducted, and then self-employment tax, which is the major contribution to the exchequer, is also part of this schedule C. And then strong documentation are required to ensure that all the expenses which are claimed are legitimate and they are not overstated, and they are necessary and has been incurred in the ordinary course of the business. So Schedule C is one of the most important practical impactful area for the individual taxation. Understanding how income, expenses, and self-employment tax work together in a critical and both compliance and strategic tax planning. We'll move to the final slide and understand which topic we are going to cover as a next session. Okay, so as we conclude our deep dive on Schedule C, one thing should now be very clear that Schedule C is not just business reporting form, it is the foundation of the self-employment taxation. So we have seen how business income is reported, expense reduced, taxable profit, COGS impact, cost margin, and home office and depreciation creates the planning opportunity. So because unlike salaried employed, like self-employed individuals are responsible not only for the income tax, they're also responsible for self-employment tax. And this is where the next critical schedule come into play. So next topic that we are going to cover is the schedule SC. If schedule C tell us how much business profits are earned, then schedule SC tell us that how much security and social security and the medical tax is owned by that profit. So in the next chapter, we are going to cover the schedule SC. Thank you for watching this video and stay tuned.